by getting back to your seats. We are going to talk now about our next topic, which is really interesting timing, considering what we heard yesterday from some of the heads of states around speeches against globalization, speeches in favor of multilateralism. Today we're going to, in this panel, we're going to talk about global economic outlook. A lot of the discussions we heard in the previous panel was focused on the U.S. economic outlook. This is about the global economic outlook, and we are very excited to host and moderate this panel today. My name is Julien Courbe. I'm a partner at PwC, and I lead our financial services consulting business here at the firm. I'd like to first introduce our panelists. On my left is Beth Ann Bovino, which is Chief U.S. Economist and Managing Director of Global Research at S&P Global Ratings. Mark Hopkins is Director and Senior Economist at Moody's Analytics. Bruce Kasman is Chief Economist, Managing Director of Global Research at JP Morgan. And then Steve Wieting is Chief Investment Strategist at Citi Private Bank. Thank you all for joining us today. And what we'd like to do is we'd like to start with a couple of minutes of opening statement from each of you, and then we'll get into questions that I've prepared, and then questions from the audience. Do you want to start?
Sure. So I'll try and keep it quick. First of all, I'm the U.S. Chief Economist at S&P Global, so I do have to put my U.S. forecast out there because I listened to it what everybody said just a little while ago. Pretty much in line with a lot of what people are saying. The U.S. economy is doing rather well. I would say, though, I think there was a little bit of question in terms of the worries about the yield curve inversion, which we think, the where things are going, it could very well invert possibly early next year. And I would say that I'm actually rather concerned about that. I think there was also a question on inflation as well. And while inflation is incredibly low, there is a worry about the fiscal stimulus that's in the market that could actually create even more inflation than the productivity generating boost that the government was expecting. And so that could force the Fed to go a little faster to cause an accident for the U.S. Expansion. We don't think that's not our baseline, but that is something. I know one person asked about that, so that's something that we are keeping an eye on. On the global growth scenario, we think that synchronized growth has slowed. We think the peak was probably in 2018. I think we're peaking for the global economy around 3.2, I'd say, for this year, and we think it's going to edge down, and that's pretty natural for a couple of reasons. One, the U.S. is raising rates, and they're going to continue into next year. That kind of weighs on overall activity. And while we do think the U.S. economy is going to remain strong this year and into the next, it still is going to slow. In fact, we're probably worried about the slowdown even further into 2020 for the U.S., largely because that fiscal stimulus will start to filter out of the system. That means with higher interest rates and a strong dollar, that's a squeeze for emerging markets as capital outflows could accelerate. I don't think we're seeing this. Some could talk about that a little bit, but I don't see that we're seeing this. Now, on the trade front, for the U.S. and China, now U.S. seems to be in a trade dispute with almost everybody these days. I'll just focus on the U.S. and China. We think the U.S. and China, they can both withstand it. U.S. so big and domestically driven. Even the 25% tariff that's being talked about that could go into effect in January on, I guess they're saying an additional 200 billion products. And of course, with the retaliation from China, that probably would cut growth in the U.S. about 40 basis points. If you talk to kind of the secondary effects, if that does kick in from a crisis of confidence among businesses, could maybe it could double it. But we're talking about 80% off of growth in 2019 in the U.S. That brings it down to under 2%, but it's not a recession area. It just takes away a little bit of a cushion. On China, China's in the process, or has been in the process of deleveraging. They could slow that down. And keep in mind that China has a lot of fiscal room on its balance sheet to really push a lot of stimulus into their economy to help offset some of this hit from the trade tariffs. from the tariffs. Another thing is that it seems like China is doing a pretty good PR campaign. They seem to be very careful about addressing the openness of their markets, basically saying that they're cutting market access for other countries. In fact, they're opening up trade agreements with other countries. The one worry we have about this U.S.-China dispute, nobody's really talking about the real issue, which is in China, dealing with their opening their markets to U.S. and foreign businesses. The forced technological transfer that had been in place for some time in the U.S. and the protection of intellectual property, particularly in the U.S., hasn't really been addressed. All we're talking about is goods. The last thing I want to say about goods, while we're all talking about goods, and yes, the goods deficit is certainly very, very wide, keep in mind, just for example, for China, for every dollar of Chinese exports that come to the U.S., about 50% or more, 50 cents, is actually U.S. made because we're largely services. Now that stuff has to be shipped a lot of places. So that's just my last line for you to think about.
So when I think about the global outlook, I tend to think, where are we? Where do I think we're going? And then why am I wrong? What are the what are the forecast risks that because the forecast probably has a 0% probability when you quantify it, as we often do with our models. And again, I would say I think of the world in three ways. 25% is the U.S., 25% is Europe, and there's the other 50%. I think the U.S. we've spoken a lot about. I would just summarize it as saying, as others have said, that we have probably a percentage point or so of GDP fiscal thrust contributing to GDP. So. And that's coming in this year and next year. So we've got sort of a good, strong term outlook, and that's been happening. But that's going to pull back in 2020. At the same time, we're going to have the tightening. So I think that there are certainly risks around both of those things. But I think what I want to focus on is, well, what does that then mean for the rest of the world? If the U.S. engine of growth that has been driving a lot in terms of financial markets as well, with strong equity prices. And demand for global exports. If this starts to slow down at the same time that we have interest rates ramping up, then that's going to put a lot of pressure on economies elsewhere. In terms of Europe, Europe's already starting to slow a little bit. It's obviously in stronger footing than it has been. Banks are much better capitalized, but there are risks. And one thing that was alluded to with respect to the Fed funds rate already being low and not having as much scope for fiscal policy and monetary policy here because of the deficits and the low interest rates. Obviously, the ECB is already pursuing much more aggressive monetary stimulus, continuing that on. So how many bolts they have left in the chamber to respond to things, I think, is a risk. And then obviously the fragmentation that we're seeing politically, and then that could proceed with economically. I mean, right now, things seem to be quiet, but we've gone from thinking about Greek exit to British exit, which is obviously on the table and coming, and there's a lot of uncertainty about that. And then questions about Italian exit and other things. So I think politics, I think that there's going to be Euro uncertainty in the next year or two. And where that takes us, I'm not sure. But obviously there are risks that I think that are around that. And then, the other 50% of the economy, Asia and emerging markets, I'm a little bit more concerned about a kind of 1990 style crises that we saw that we haven't really. We've been so focused on the last decade with the Great Recession and something coming out of the blue. I think Asian countries, by and large, are well equipped. They learned their lessons in 97, 98. They seem to be, I think, fairly. They're not as subject or at risk of an emerging market crisis. But the big caveat was that they're tied closely to China. There's a lot of risks around China, notwithstanding all the trade issues. But leaving them aside, I think there are pressures. I think Latin America. There's a lot of risks there. I think that there are several countries that are at possible risk of a currency depreciation. I mean, we've seen what's happened in Turkey recently with a large depreciation. I wouldn't be surprised if Argentina, Uruguay, South Africa, I'm not making a prediction, but I think all these countries are potentially at risk for some of the reasons that were alluded to earlier with capital flows, and then as the Fed starts to tighten, that puts pressure. And we've seen this script before play out in the 90s, and I think there are risks there as well. So,
right. Thank you, Mark. Bruce?
Yeah, I guess I'd like to make two thematic points about the way we look at the global economy right now. The first is regard to how we're moving through 2018 and likely to go in 2019, and make the point that I think there's a very strong underpinning of resilience that's in the world right now. Oh, I'm sorry, I forgot to turn my mic on. Usually that's not a...
Apparently I'm louder.
Okay, is that better? Okay, so I want to, on a cyclical basis, focus on this idea that there's a very strong case to be made that there's a lot of resilience to support global growth, and not only support global growth, but to normalize business cycle conditions. And I mean by that to begin to lift inflation back to normal levels, begin to push interest rates back to more normal levels. I think that resilience comes to an important degree because we've finally gotten through, I think, the shocks and the lingering drags from the global financial crisis. It comes because we've generated over the last 2 years very balanced income growth, with corporates and households both getting pretty important benefits from the expansion, and that shows up in the confidence readings that you can see. And I think the final point is that we still have pretty supportive policies across the board. That should give you a good global environment, but there are almost always, as we make transitions, points of stress, and we can see those points of stress coming right now. Most of it is in EM, where you have higher dollar interest rates and some idiosyncratic things combining to create stress, and some spillovers from that. And you also have China, which is in the process of a self-directed tightening in credit conditions, which has slowed its economies. I think the basic call we have is that we're going to be okay, but it's not one I want to pound the table too hard. When you have cross currents and you have points of stress, you always have to be worried that something could turn out to be worse. But we're making effectively three judgments. One is that the U.S. engine isn't going away. It's not going to deliver sustained 4% growth, but the fiscal stimulus is still in the pipeline, and I think corporates and households are still on pretty solid footing. The second point is that there's alternative engines elsewhere in the world, and there I just focus on the idea that European growth has been sluggish this year. I think it is still an important complementary engine. And the third point is that the Chinese economy is going to get benefits here as policymakers are beginning to reverse course and are providing stimulus. It's not happening yet, but I think in the next 3 or 4 months we're going to see that. If that's the case, I think we continue to grow. I think the supports that come from that nexus of the US, Europe, and China limit potential credit problems in EM to an important degree because it prevents the magnification of those shocks through terms of trade losses, which were so powerful and negative in 2015 and 16. And I think if we are right, we have to then focus our attention on the more slow-moving, broader issues around the normalization of the business cycle, which is to say, if EM doesn't kill you, higher interest rates will kill you. And that is a process which the positive is it's going to move slowly, but the negative is it's going to keep moving. I think when we look at where interest rates are today and you run through a modest continued normalization of the business cycle, you can see Fed policy rates getting up another 150 to 200 basis points over a couple of years. You can see the need for European central banks to begin the normalization. And I think eventually that, with tighter labor markets, and what I want to argue is your real problem in the world today, which is the ugly and very weak supply side performance, which is part of why we have cyclical constraints here, is your more medium-term problem. And I think it's very important to understand that the focus that people have, and rightfully so, with the experience of the last decade, is to think about when the next crisis is going to come and when the next deep recession is going to come. And we have not rewritten the rules of the world. There will be points of stress. There will be countries that have problems that are severe. We can already see it in Turkey and Argentina. And we're going to have a U.S. recession at some point. But I think the real problem the world has right now is we're not generating supply side performance. And as a result of that, and the lack of policies to address that, in fact, you could argue that what's going on the trade side, what's happening in other spheres of policy are actually moving in the wrong direction. means that we're basically stuck in a mode where the underlying pace of income generation is going to be far slower in the next 5 to 10 years than it has been over the last 10 to 20 years. And the failure to address that against the backdrop of problems of elevated debt, of demographic problems, of populist pressures building around the legacy of inequality and other sectoral adjustments going on in the world. That is the threat, and that is the reason why we are dealing with Brexit and we're dealing with the U.S. trade policy, and the way it plays itself out over the next 5 to 10 years is not easy to map out. But I don't see anything that moves me away from this idea that we're on a path of malaise here from a structural supply side performance point of view. And that is, I think, the biggest issue that we need to address and push in terms of what can change things on the policy side in the global economy.
Right. Thank you, Bruce. Steve?
Thank you. So looking at the coming year, we are generally in agreement with the optimists on the outlook, but I think it's very important to see where we are if you compare the United States and various other parts of the world. We are very fortunate on the US side. I think we have a convincing rise in compensation and in inflation, but the acceleration that we've seen is actually at lower levels than we saw at the lowest points of any time in the prior expansion or the one before that. So this starting point for the inflation rate allows us more room for the Federal Reserve, again, to continue on a gradual path. The cyclical imbalances in the economy, the things that we would see in excess that we would give back in a recession are still quite mild now. And that gives us another year of probably sub 3% growth as we don't repeat fiscal stimulus. The growth rate around the world is probably stronger than markets are now discounting. I feel like if we look at the world and financial markets, it seems as if we've just generalized to the United States and the rest of the world all being the same. It's as if Turkey and Taiwan are all the same thing in emerging markets. And if you take a look at a good deal of pricing in financial markets, where many currencies, many equity markets, is very, very hard to find a market outside the United States that at the moment is in an upturn after summer months of decline. So I want to address a couple of those questions, but also just mention that when we think about the outlook for the rest of the world, in many cases we have a less complete recovery. Europe is several years behind the United States. I don't know if they'll ever fully be aligned with our business cycle the way they've been before. In many other places, I think Bruce already mentioned, China, the bulk of the slowdown is in fact in parts of the economy they control, and that preceded any of these trade issues. So we have a pretty good view of the world economy over the coming 12 months. And unlike the early 2016 or 2015 period, there just are no economic contractions around the world right now to match this asset price performance. And that suggests we're going to be seeing a rebound. But why did we see this divergence in performance around financial markets? I want to explore it from the US side and the non-US side. So the trigger of these US tariff threats is pretty meaningful. There's a good deal of policy uncertainty, both driven by the Federal Reserve, as well as whether or not we're going to see tariffs broaden beyond the clear motioning towards China, things like auto tariffs that could affect Europe, where NAFTA is, all of these sorts of things. Ideally those things are contained, but we've seen a pretty big reaction to that around the world. And then, of course, we saw the most vulnerable EMs, those that require tremendous savings flows. We've already mentioned Turkey and Argentina spiraling down into a confidence crisis and not seeing the flows of foreign capital to refinance their positions, having very negative potential future effects on their inflation rates and economies. But the broadening out of all of these risks, we think, has gone too far. And it's really, again, reflected back on what is the global outlook in an environment in which the United States is playing hardball on trade. Now, this important point I'd like to make is that when I hear a lot of economists talk about the tariff collections, the tariff collections are no more than 25% off of a particular number. And you can scale these things against GDP in the United States. You could take a look at it if on a bilateral basis, perhaps someone's going to find another country to trade with and it won't have that much net effect. Well, all of those things look very small scaled against global or US GDP. If you scale it against lost business for particular companies, if you scale it against profits, it becomes much, much larger. Just take the example again, if we wanted to collect $100 billion in tariffs on a $20 trillion US economy, well, it's half a percentage point. You scale it against $1 trillion in large cap corporate profits, and suddenly $100 billion is 20 times as large. You scale it against this year's growth rates of profits, and it's 100 times as large. So what we're seeing in terms of the cyclicality of markets, financial markets are of course much more vulnerable than underlying economies, but the scope of the movements we've seen in financial markets has been, I think, very reasonable and line for the potential profit hits of certain companies. And that brings me back to the US reaction versus the global reaction. It's interesting, we have the Institute for Supply Management report. It's been around for 80 years. And in the month of September, 5 out of 10 American manufacturing industries cited difficulty with the steel and aluminum tariffs. And it's quite interesting, again, it's not derailing broader manufacturing's upturn in the United States, but the steel and aluminum tariffs are really child's play compared to all of the potential tariff threats. And so then we look back at the US market reaction, and we've had tax cuts, which are a great incentive to produce more in the United States. They've created this re-leveling up in the net profit level of the United States market. We think in the last couple of years we did a lot to discount that, but what's interesting is that since the tax cut, we've seen an unprecedented incremental rise in share repurchases. So we went up, tax cuts worth I think about $140 billion across the economy for 1 year. We went up $50 billion in the first quarter alone, to a level of $175 billion in share repurchases. By the second quarter, we've only boosted it another $2 billion. And it's at a very, very high level. But I do think that we can easily make mistakes here in saying that none of these tariff issues, nothing that would really affect the supply chain, particularly for complicated products like autos, that this is something the United States is going to just brush away. In our own studies, when we looked at the companies impacted in Asia or Europe potentially by tariffs that may or may not ultimately last, 2 out of 3 of the companies that were impacted were American suppliers to those companies, I think as Beth already mentioned. So I think it's a little bit worrying after we have this high confidence level in the United States, a low unemployment rate in the United States. We still see it lasting. But recessions are really born in those periods of high confidence. And that's why I'd be a little bit careful about these particular policy risks.
All right. Well, thank you very much. Very interesting comments from all of you. Let me maybe, and you covered a lot on the trade issues and the impact on the US economy. Let me maybe dive a little bit into some of the topics you mentioned. One thing that I think is quite interesting is to see many of the other countries starting to organize themselves outside really of the US, right? Japan signing significant agreement with Europe, getting more involved into some trans-Pacific agreements. Is there a risk that the US might get more and more isolated and kind of the rest of the world organizing themselves with the new trade agreements that, again, will create more pressure on the US economy?
I'll jump in real quick. My 2 cents is that I see near term, the US is still basically the second largest exporter of stuff and the largest importer of stuff. So people need us. Basically businesses need us around the world because we buy all their stuff. But the worry is what you had just mentioned is near term, probably not a big impact. But over the long run, the decision for the United States to take on this much more isolationist approach could be damaging. When you have trade agreements being formed. And the reason why, for example, TPP was even instituted was actually to control China. Now we see the U.S., I don't know if we decided to join again. There was talk back and forth about maybe we will, maybe we won't join the new TPP2. But with the U.S. pulling back, that gives China more room, and so we see that as a concern. NAFTA, for example, we do think that NAFTA 2.0 is going to likely go through. We think the U.S.-Mexico, people talked about it as a bipartisan agreement and that maybe Canada will be pushed out. We didn't think so much. We think that actually the agreement between Mexico and the U.S. actually opened a lot more of opportunities for Canada, and Canada's sticking points, basically the Rule 19, or having arbitration or dispute settlements on international courts, not in the U.S., that's their leverage point. The U.S. actually has, Canada needs to open up agricultural markets, particularly dairy. They could actually reach an agreement, so you could see NAFTA 2.0 coming into play. But the worry we have is that if that was ripped up, what you'd see is actually even a slower competitive competitive angle that the U.S. would have, U.S. businesses with the rest of the world. So,
Any other comments?
I mean, I think in some ways we don't want to lose sight of what the big issue is here on trade policy. Yeah, the U.S. role in the world is going to be affected by what's going on, and I think that's a longer term issue which is very hard to map out at this point. But if we're kind of sitting here in 2018 into 2019, I think we have to realize that the U.S. is a very powerful demand engine for the rest of the world, but it's not primarily through our trade. As a country, we're relatively closed. As a share of global trade, we're actually not that big. Our channels of transmission come through a whole host of other linkages that have to do with financial markets and the role the U.S. plays, I think, in terms of creating the infrastructure for global relations. And I think the question on trade, and I agree with what Steve was saying, it's a wild card in the forecast that we don't want to underestimate, is whether or not what we're engaged in here is the U.S. putting pressure on other countries, particularly China, to open up their borders, or whether we're engaged in the U.S. In a war on trade. To the extent that we're spending our time battling with China and it stays contained in that, and I don't really think it matters in a big macro picture if we go from 10 to 25% tariffs. It will matter somewhat, but I don't think it's a big swing factor on the global outlook. I think this is a limited event, and I think it can be maintained within the outlook, which I hear from just about everybody on this panel. I think if you get to the point that we start to see the U.S. integrate foreign policy with trade policy and begin to move towards changing the rules on global trade, breaking up NAFTA, putting auto import tariffs on the rest of the world, using the Iranian sanctions as a lever to use trade policy differently, then the way businesses are going to respond and the potential magnitude of that response, I don't think we can by any means underplay that. And it is, conceivably something that, as you watch some of these points play out, could kick in as early as 2019. It's not happening now. And I don't think it is triggered primarily by U.S.-China relations. It's whether this administration is changing the rules that have been put in place over the last 80 years, and which it's been the primary defender and architect of. If that changes, all bets are off on what happens in the global economy.
So just quickly, I think we should look at all the ways, I think just as Bruce has just alluded, all the ways in which China and the United States are integrated as borrower, lender, supplier for local demand in Asia, as a potential growth source for U.S. services. And it's not clear whether or not we had a limited goal that we can just achieve, like intellectual property protection, for example, when we have all of these other issues. So again, are we in fact trying to protect or open markets is an important question. And then you can see this reaction around the world to things like, again, the Iranian sanctions. And is this something in which we now have a force of gravity in other countries that are trying to push away from U.S. policy?
I'll just say something very quickly, which I think is just broad brush. Economists have two hands. They have a wide variety of political opinions of their own. Surprisingly, if you look at rank, what do they agree on? Where there's a consensus? It's usually free trade. Economists generally support free trade of all political stripes. And what's interesting, though, is that free trade isn't, it's sort of taken, well, free trade is always good. And that's not actually true. It's more than it's a prisoner's dilemma situation. So you can always do well in the short run, a lot of times without free trade. but over a repeated game in the long run, you do worse if you don't have free trade. So I think if you look at a lot of what this administration is doing, it's essentially trying to get the short-term payoff for the long-term cost, whether it's trade or it's other things. So I do think that there's a risk. And what's interesting is that UK outperformed expectations after Brexit. The U.S. economy outperformed expectations after the Trump election, people thinking that there would be trade wars and such. And I think that's also possibly, it's a speculation, partly a reflection of the fact that there is this sort of short-term payoff. And so to go to your question, I think that there are costs, but I don't think that it's something that's going to be in the sort of short-term perspective that we can easily quantify. I think it's really down the road, and so it's hard to think about, but it's there.
Can I ask this one more question? Something Bruce, you brought up. Who thinks they're changing the rules? I mean, you mentioned it. Is it? I mean, what would you say at this point in time? Is the U.S. changing the rules in terms of the trade, the overall trade position? Is it not? Because I would say they are. I am much more concerned.
I think they're changing the norms.
And so
that's
because through some of the things you said, I was like, well, aren't they doing that? Aren't they? At least they're threatening to do that, and that's to me
I would say that one of the more important events of the last couple of months and has helped markets is the deal being made with Mexico on NAFTA, because I think that's the first tangible step that you've seen that the U.S. actually cares about our trade agreement in North America and was willing to compromise on things. I think that has been a more important market event in the last 4 to 6 weeks than the escalation of the tariffs on China. There's no doubt the U.S. rhetoric has moved in a direction that is challenging the rules, and I think using national security as an excuse for putting tariffs on is a shift in terms of norms. But in terms of the actual movements we've made, and I think when you look at what's happened in NAFTA, the cooling off of EU-U.S. relations so far, there's a sense in the world that we are in the midst of skirmishes, but not breaking down the trading system that the world has built up. And I think it's still in doubt where we actually go with this as we integrate it with what looks like a stalled negotiation with Canada, Iranian sanctions, which could play into EU trade relations, and the Chinese story, which could escalate in ways we don't appreciate. I want to make one other point, if I could. I would definitely not argue that trade policy has helped the U.S. economy this year, and I would definitely not argue that Brexit has helped the UK economy. The UK economy has been growing 1.5% over the last 2 years, so we didn't have the recession that some people thought we might have after the Brexit agreement the Brexit resolution was passed. But for the UK to grow 1.5% when the US is growing close to 3%, and the euro area is growing 2.5%, is an underperformance that could be measured at about 2% growth loss per year for 2 years. What you're seeing is a chronic loss that people aren't appreciating because it's not coming in an acute disruption. And we should recognize the UK has changed its path, and I think there's other things going on. The fact that the US unemployment rate is less than 4%, given the growth we've generated and the recession we had, is a reflection of how weak our productivity performance is. It's a good thing to get labor markets more healthy. It's a good thing to get wages growing. But if we keep tightening our labor market and we don't get productivity growth, that may not show up in high inflation, but it's going to end up showing up in compressed corporate profit margins, which is going to undermine this expansion at some point. And I think this is the sense of these chronic problems that are building here and they're not going to go away, and you don't necessarily feel in any one quarter or 1 year is really the major problem the global economy is facing right now.
Actually, the UK is living, as we all know, leaving the bloc on March 29th, 2019. Do you expect a different kind of outlook for the UK, or do you expect maybe renewed different relationships between the UK and the US after they leave the European bloc?
Somebody want
Between the US and the UK? I mean, I think that the nature of that relationship goes back so far that it's not going to be too much affected by Brexit. That would be I mean, the EU and the UK, obviously, it's going to be a huge issue, and there's issues that are being worked out. But to be clear, I didn't necessarily mean that GDP growth was stronger in the US or the UK. What I meant was that there spreads and risk measures, that there wasn't this sort of immediate sense that the sky was falling, which some people thought. Because it's definitely going to be a drag.
On the March 2019 thing, I don't think we're going to know what Brexit is at that point. We're going to have we hope we're going to have a transition agreement, which is going to leave unresolved the UK relationship with the EU at that stage. And that as a result of that, you're going to keep in place most of the restrictions in terms of doing things like new trade deals and other things. So I think the idea that this is going to be clarified in the next 6 to 9 months will only happen if we have a hard Brexit, which I think is not the likely a no-deal scenario. I think that's a very unlikely situation to go in. I think we're going to play this out over 2-3 years before we see where it actually heads.
I would say on that, on the UK-US, the question of going into a bilateral trade agreement with the two, as was said, they have to wait until they're out of the EU. They can't actually do anything until that takes in place. And I think once that is to happen, the worry, of course, is that the US is going to have a lot more leverage over the UK. So the question of beggars can't be choosers might be an issue again for the UK once they are in the position to start to negotiate with the US. On the EU, we haven't really talked about the dispute, the trade dispute with the US. Obviously, steel was a big factor, but there's also the question of autos mentioned a little bit earlier. We think what's happening with the EU, it's been quite a kind of all quiet on the EU front. There's a few reasons why you could see that. It was mentioned a little bit earlier. It's that they've got their own domestic problems. They came to some kind of agreement, and I guess it was Juncker and President Trump came to an agreement that they will resolve our trade differences, but it's been quiet ever since. And I think the reason, at least on the EU side, is can't really deal with this right now. They're dealing with what's happening with Italy, with all the domestic issues that are at play. And another thing is, in terms of the auto issue, obviously the auto trade dispute is very big for the EU, particularly Germany, also for Canada as well. But in Germany, they're still dealing with Volkswagen, the emissions problem. They haven't fixed it yet. So why start to push the trade issue when they still haven't solved that problem for one of their major car companies?
Yeah. Just to switch a little bit before we go to the audience, let's talk about emerging markets a little bit. I think some of you guys mentioned some comments on maybe revised growth projections for some countries like Brazil, Argentina, India for sure. Do you see some emerging markets specifically that where you maybe are more optimistic of their opportunities globally and the outlook from an economic standpoint?
Sure. Well, I think we have to look at emerging Asia, and again, there's plenty that you could find that's problematic everywhere. But if you take a look at emerging Asia, it's the only region of the world that is gaining global share over time. It's closing in on 4 billion people, a high savings rate that's falling now. It's able to fuel some consumption, some local technology that could end up with this bifurcated world, gaining some dominance regionally. And just again, from the perspective of, well, why would you care? You'd care to diversify your investment portfolio in multiple regions and have a much less volatile portfolio if you do that and end up with, in the end, a stronger growth rate because you don't always have to absorb all of the local idiosyncratic risk. So emerging Asia looks very good to us, and obviously there will be some little problems. Folks tend to get often a little too optimistic in India, a little too pessimistic on China. That can happen from time to time. Latin America, I mean, you take a look at how Brazil looks right now. Its currency is roughly where it was when its economy was contracting very sharply. There was civil unrest over the political decisions, including the impeachment of the president. The oil price, which is important technically to its financial markets, had plunged through $30 a barrel, and the inflation rate in the country in the last couple of years, wouldn't justify anything like that depreciation. And you see this again in a lot of emerging markets. So people tend to be confident wherever financial markets are performing strongly, and they're extremely pessimistic, wherever they've been sold off. And I see that as a real troubling issue again if people run their portfolios, looking backwards.
I mean, I think what's interesting and important about emerging markets right now is that there's effectively three stories, as I see it. Given that we're broadly right that the U.S. isn't going away as an engine and Western Europe is there as well. I mean, the first story is there are countries which, in response to higher U.S. interest rates are coming under stress. Those are countries with current account imbalances, political credibility issues, and dependency on foreign funding. Turkey, Argentina, Indonesia, South Africa, India maybe as an issue there. The second part of the story is China, and China is always the story in EM. It's the elephant in the room. And that's a big call because they have been slowing, but if we're right, they're going to be kind of bottoming out without necessarily getting a big lift. And then the third, I think kind of along the lines of where Steve was going, those countries that are levered to US and European growth, those countries that get helped if we're right that global commodity prices stay firm, they do well. EM Asia outside of China, your tech producers also get help from a mobile device cycle that's kicking in now. Mexico, if we're not blowing up NAFTA, does well. The Central Europeans do well. So it's a very, I mean, there's greater, I think, divergence in EM, both now as well as in the outlook than is appreciated. But the core question in EM, I think, right now, and it's one of the 2 or 3 core questions for the global economy, is whether China, which is at the intersection of a lot of these cross currents, is going to be successfully navigating towards stable performance. I mean, as we talked about, I think it almost is a theological question. Does God exist and can it control?
All right. On this comment, let's turn to the others for questions. The mics.
I have a loud voice.
Hold on, I think the mics. This one gentleman here.
So this question is for Dr. Kasman. I think I heard you say that one of the biggest issues is on the supply side, and I was wondering if you could elaborate on that. And I wondered too, Beth Ann Bovino said that a major issue was protection of intellectual property. And I'm wondering if those 2 concerns are related.
They're always related.
Everything's related. I'm not. I'll let Beth go there if she wants. I'm not going there. But look, we have a problem that productivity growth globally has moved dramatically lower over the last decade. It's pretty common across the world. You can debate whether that is a cyclical phenomenon or a structural phenomenon. I would take, without getting into that messy argument, I would take the view that it is a fundamental story, and that, as I said, you're not doing anything material here on the policy side that I think is really going to change that. And then you have the other problem, which unfortunately is me, that the demographics with the baby boomers moving into retirement age is hurting. I think U.S. potential growth today is 1.5%. I think that it doesn't take more than 75 to 100,000 jobs created per month to stabilize the unemployment rate. And you heard in the earlier session people talking about a 3% unemployment rate in the U.S. I mean, that's a good thing in terms of we want labor markets to provide benefits to workers, but if you're not getting the productivity support and you're starting to build pressures, and I'm not arguing this is happening that powerfully now, that is the recipe. If you go back and look at the last 70 years of U.S. economic history, it's the recipe that says your expansion is going to be vulnerable and come to an end. It's not just the U.S., it's, I think, global. And again, we could go over this in terms of what policy is doing, but certainly I would argue that I look across the sweep of what's happening on policy. I'm not sure I want to argue we're moving in a negative way, but I don't think we're addressing the problems in a way that I'd say we're being constructive here.
Can I just ask what you would think would be a way that's constructive?
Well, let's take the U.S., for example. Simple, almost, well, not costless in the political sense, but costless in the economic sense is, what is it that we have the biggest comparative advantage in the world on? I think that's attracting skilled labor from the rest of the world. You want to deal with our supply problem, you want to deal with our budget deficit problem, our demographic problems, let people who've got a graduate degree or a BA in the U.S. stay here. You'll change supply side performance in the U.S. materially, and I'd like to argue that that probably will boost productivity growth as well. Now that's taking away from other parts of the world. I think part of the problem, I would say, is that some of what's happened on productivity, not all, is about technology. It's about the fact that technology isn't adding as much to growth today as it was 20 years ago. And that's not easy. That's one which I don't think is an easy one. And again, leaving aside our immigration policy, demographics are destiny. It's not easy to to get around that. So some of it can be, I think, changed, and I think we should be addressing that. But I would, in the tone of your question, I do think there's a piece of this which is unfortunately structural and hard to see how we're going to turn it around.
Should
But
I,
how much can you explain this backward look in technology actually contributing less to output growth, and say that any of that would be predictable, and where can you say can it go going forward?
Well, let me give you the Bruce Kasman personal experience. When I started working in the financial sector, it was 1985 when I was at the Federal Reserve. I came into the office the first day and I had a pencil, Rolodex, paper clips, yellow pad, and an HP 12C calculator on my desk. 6 months later, I got my first PC and I opened it up and I saw Lotus 123 and Word for the first time. 4 years later, the internet came with email. 4 years later, mobile devices came. 1985 to 2000. You tell me what since 2000 has changed the way that a worker interacts with technology in the US economy in the same way that we had there. That's your productivity slowdown. It's not that technology isn't changing. It's not that some companies are taking advantage of the technology in a very big way. And it's not that I know what technology is going to do in the future. What I'm saying is we had a wave that boosted productivity that's ebbing, and it's very evident in the data that that's happening across sectors and across countries.
well, I just wanted to jump in here. First, I wanted to answer your question too. But in terms of the productivity story, I'm in agreement. And one of the reasons why I gave that scenario of could we see more inflation later on? Could we see an inflation? We're not talking about something like we're back to the days of the 1980s where Volcker had to raise rates to 10% for the federal funds. We're not talking about that. But even a smaller upside to inflation, forcing the Fed to raise rates when we do see our forecast for the potential growth rate at this point in time is 1.8%, but it's actually coming down given that we see not just retirees leaving the workforce, losing their productivity. We don't even have to talk about the technological issues, talk about just the loss of bodies, losing the retirees because we no longer gain their productivity. And then the other question, of course, is we have a lot of people of prime age also out of the workforce. That means slower growth. So while we have a 1.8 potential growth rate, we could see the risk is on the downside. That means that with that in mind, with the slowing of the U.S. growth potential, the risk of a Fed accident is certainly real. And I did want to answer your question about the IP question. That I think what you were talking about when I mentioned U.S.-China IP, I think that's what you were referring to when I mentioned that one of the things that we found worrisome is that what the talk has been in the United States, or basically in the news anyway, is that everybody's talking about the goods deficit, that we have to narrow our goods deficit, and we certainly have a very large bilateral trade deficit with China on goods. But the other thing that's not really talked about is the United States has a very large trade surplus in services. And if you break that down, I'd say about two-thirds, no, not two-thirds, I would say over half. Over half of that surplus in trade in services to the rest of the world is what's called digitally deliverable services. That would be IP. That would also be financial services. Like, for example, S&P Global, where I work, has a subsidiary in the UK. We also have one in Paris. That's considered an export of services. There I say the question of what's happening with China, there was three issues that really needed to be addressed, is how do we deal with the strategical trade relationship with China, particularly when we're going into services, because China is also developing their IP, they're also developing their trade and services. They're becoming much more of a competitor for us. What we've seen China had done, and I don't think this is really disputable, is that China has certainly closed the borders or made it much more restrictive for businesses to enter into China. And when they do, there was what was called a forced technological transfer. Businesses had to give their stuff over, their technological know-how, and China would use it, and then you often throw them out afterwards. And that goes into the question of intellectual property. Is it protected? The U.S. demands that it's protected in China. Is China going to meet those demands? And that's really where the risk is.
There was a question on the first one.
You had a question, sir?
That's the mic is coming.
Okay.
Here, right here in the first row.
In terms of American isolationism, we haven't addressed the question of deregulating on environment. America's uniquely done this. The Chinese are taking quite a lot of advantage. They see markets in the future. The German model is quite advantageous and work rather well. But if you had the science faculty in this room, they're going to tell you regulation is going to be tightening up and tightening up. And we're not going to be able to reverse that process. How is America positioned over what is no longer long term, it's actually short term now on this issue?
Well, I think the point you're making is the right one. It's not obvious. It's when we first saw the election, I think one of the big things that boosted business confidence, certainly my interactions with corporates expressed this, is that they felt that the government was going to be less intrusive in the regulatory policy. And I think that has had some impact, if not just on sentiment, through other channels as well. But I think the point you're making is it looks very different now, depending on what part of the economy you're gonna, take a microscope and look at. And I don't have a clear message to you that I understand how regulatory policy is going to affect the economy in the next 5 or 7 years. So for me, it's kind of a cloud that may be important, but it's hard for me to get a macro view that's strong in either direction.
I think do one more question in a couple of minutes. So.
Another one for Bruce. Your firm recently had a report which discussed a global liquidity crisis. What sort of probability would you attach to something like that happening over the next couple of years? And if it preceded an economic slowdown, what kind of an economic impact could a global liquidity crisis have? And for the other panelists, do you think this is a possibility?
So I'm going to answer from my perspective as a macroeconomist. I think that the underlying forces that drive recessions, and recessions are nonlinear shifts in business behavior by nature, have both financial and real side underpinnings. And almost always, in fact, I can't think of a case, certainly since World War II, where some combination of tightening labor markets, restrictive Fed policies, corporate profits coming under pressure is an underlying source of that vulnerability, because that has an impact on how financial intermediaries have to shift their thinking around the world. It has an effect on asset prices. It has an effect oftentimes on having to force people to make different decisions than they thought were valid before that. And there's almost always financial stress points. And I think when you look at the world today, the two things that strike you in terms of where those stress points might show up is, one, that there's a lot less liquidity in assets that we tend to think are easily tradable. And the second one is there's a lot of leverage out there on the corporate sector side, both in the US and globally. So my kind of thinking about this is that these things become accelerants, that they don't cause the next recession. But in the environment of a macro environment that's deteriorating, and as these changes in behavior begin to take hold, problems around liquidity, problems around leverage begin to magnify things, and ultimately are why you get the nonlinear shifts that raise unemployment rates so sharply over short periods of time.
I was going to add, in terms of it was something that S&P Global, my colleagues over in the corporate side, did something on. I'm focused on the U.S. right now in terms of the corporate debt, which is now at a record high. It surpassed the 2007 high. What we've been looking at, and we do have in our credit conditions committee, we do look at basically kind of corporate debt is something that could be a risk. We're watching that as a risk to the corporate credit conditions. But one thing that my colleagues have done is they looked at a comparison between BBB, because BBB, talking about the S&P universe, BBB issues that BBB corporate debt, which makes up about 40% of that overall corporate debt that's out there. Add to the lower level securities, it makes it even bigger. But what they did is a comparison of BBB corporate debt, their balance sheets today versus where it was in 2006. And the small silver lining, and although we do caveat that we are watching this and it is a concern, the small silver lining is the balance sheets today for those BBBs look a lot better than where we were in 2006. Might help you sleep a little better. Something to think about. I did want to mention on your deleveraging. I'm sorry, your on the deregulation story. Something that we're watching, as kind of Bruce had said, it is pretty much all over the map in terms of what companies are benefiting from that. But one thing to take a look at, and what we've seen, is if you look at the fines, the number of fines that the U.S. government has initiated, it's dropped significantly. So even if you're not necessarily seeing a lot of the deregulation going into place, that you might see big things being signed or things being ripped up. But what you are seeing is the administration's new legislators are maybe looking at it with a flexible eye. So that's one thing to account. Now the question, of course, is this a boost to GDP in the United States? Probably so. I mean, if you have less red tape, it makes things easier to get through. The question, of course, will we pay for it later?
All right.
Did you?
I just wanted to discuss just liquidity and confidence. We sort of sometimes mix up the two a little bit. We just begin with, the notion that the Federal Reserve is shrinking its balance sheet. It's done so by about $200 billion thus far, and that requires a savings flow from someone other than the central bank to finance the U.S. government, and that represents a fundamental tightening of monetary policy. And with that, you'll have some weakening in U.S. dollar liquidity for vulnerable borrowers. That's one thing. The other side of this, though, that people often confuse with liquidity is confidence itself. And in the notion that if some security is mispriced, if something is down and you believe and you fear that no one else will have confidence to buy it and you shun it, you get these periods where you could see just widespread displacements in markets, and that really comes down to, again, just investor confidence. It's not really, and can manifest itself in poor liquidity and asset prices. So I just think, again, over and over again, we've had cases where even financial markets, with all their wisdom of the broader crowd, can make big mistakes in the way that we price financial assets. And often that just comes down to a crisis of confidence, this contagion of confidence rather than this contagion of true economic linkages and weaknesses.
Yeah, I would just add really quickly that, I agree that with this notion that it's not that I think a liquidity crisis would happen organically, but this idea that the conditions are such that the credit spreads are very narrow, equity prices are very high, the conditions are such that if there was some nonlinear thinking, change in confidence, that the road is lots more slippery now than it would be before. And so that's the risk, I think.
All right. Well, thank you. We would like to, of course, stay all day on the stage, but I'm being told that it's not possible. So thank you so much for our panelists today to come here.